Alrighty, good evening, guys. Just doing a quick sound check. We've got a new microphone to make sure it's a little bit clearer. Could you let us know if you guys can hear us and see us? Perfect. All right, awesome, guys. Fantastic. Thank you so much for joining us this evening. So Nathan and I are super excited. We're going to be rolling into, probably next year doing these more regularly. So really it's just an opportunity to sort of impart a bit of knowledge on our clients and those who are interested in investing. But essentially we want to, discuss a little bit about why we believe Perth is a great investment opportunity at the moment, and some attributes that we kind of look at as well with regards to investing as well.
Yeah, perfect, guys. And as I said, more as Josh sort of alluded to, just imparting a bit more information on yourselves. Obviously, we all know our own backyard, but there's going to be various markets, particularly now that Sydney's had such a nice little run over the last sort of 12 months. Other markets will start to show themselves full potential, and it's giving you that information to make the right investment decisions moving forward.
Perfect. All right, guys. So we're going to kick it off. All righty. All right. So for this evening, essentially what I want to do is just give you a bit of a breakdown as to sort of what we're going to discuss this evening. So really briefly going to tell you a little bit about AssetBase, who we are, what we do, how long we've been doing this for, and our track record. So both Nathan and I are managing directors, so we're going to run through that with you guys. What we're also going to discuss is essentially a bit of a methodology and what smart investors actually look for. Okay, so it's all well and good to say, oh, look, I've made a lot of money in the property market, but what are the attributes that you actually need to look for when you're making a smart investment decision? We're also going to talk about the changing property market. So there's been a tremendous amount of growth in the property market over the last 18 months. And we are entering a different cycle. So we're going to explain to you, what cycle we've been in for the last 18 months. But then as well as that, what is the cycle moving forward as well? So what are the attributes, what's actually happening as well? We're going to drill down and talk a little bit about Perth as a capital city, the attributes, the economy, why we believe it's poised for, both positive cash flow from an investment perspective, but as well as that, capital growth. And then we're going to discuss a little bit about sort of some high-level discussions about locations. Essentially, for us as an organisation, we're really big on yield. And so cash flow positive locations, meaning that the properties essentially pay for themselves. Now, at the end of this evening, we'll have a bit of a question time as well. So please save your questions for the end, write them down, then we'll go through the chat and basically run through any questions that you might have. Okay? All right, fantastic. All right, so AssetBase. So AssetBase was founded 5 years ago by both Nathan and I. We have a team of 11 here in our business, and we've got a combined over 40 years experience assisting clients purchase real estate. I've been doing this now for well over a decade along with Nathan. Okay, so we've got plenty of experience, and we've helped clients purchase all around the country in nearly every single state in Australia. Actually, no, in every single state but in Australia. Exactly right. At AssetBase, we've, assisted over 400 clients purchase real estate, which is very exciting for us, and helped clients acquire over $120 million of real estate with another $200 million of predicted capital growth over the next decade. So a tremendous amount of impact. We're very proud of what we've built here, which is a very ethical business based on fundamentals and making sure that we deliver the right outcomes to our clients.
So I guess what we're all here for is what do smart investors look for? So when a lot of people invest into property, the biggest mistake that they can make is normally following the hype. So they follow the hype, whether it's come from mum and dad, whether it's come from the taxi driver, or they've had a chat to somebody at a barbecue that's made money. Any paper that you pick up these days normally has a hotspot that you should be investing into. And like with all hotspots, it drags the herd. So when we are a smart investor, we're looking for key fundamentals to make sure that what we are investing into is not only a quick burn, but it's a long burn that's going to give us that capital growth and that yield over an extended period of time. The first thing we're chasing is an economy. So it's interesting in this sort of a marketplace where we've gone through coronavirus and a whole pile of other hurdles this year, because a lot of state economies, a lot of federal economies are starting to struggle. So what we are anticipating for a lot of areas is there's going to be a real sort of a slow period particularly with state economies. And the one economy that I guess has sort of stood up to date is Perth. Now, a lot of us obviously not overly favourable of Perth of locking down their borders, but it has actually worked really, really well for them.
Absolutely.
In insulating their borders and obviously keeping a very, very strong and steady economy. Population movement's another big thing that we need to start to look at. And again, with coronavirus and the lockdown of borders, what we've sort of seen is obviously no external population movement into the country. So Australia hasn't had any university students coming through. They've had no migrants resettling, which has really put a tightening on the market in Australia and across the country, across all states. We've got infrastructure. So infrastructure spend both on a public and a private level, and making sure that we've got that infrastructure there to support employment, because that's one of the big driving forces, obviously, with economy and the population movement. Your residential mix. So again, with all hotspots that people invest into, generally what you'll find is that there will be a large investment mix as opposed to owner-occupier mix. So when we do invest into areas, we want to make sure that we're not following the herd, but we're going against that. We're buying into areas where it's predominantly owner-occupiers, as they will be the ones that generally push the capital growth, push the equity up in an area, but they'll also make sure that the vacancy rates stay tight, which means that you're going to have tenants not only initially, but long-term. Rental yields, again, with interest rates at record lows, they will start to creep up. So we want to make sure that any investment that we're investing into has not only a yield that will cover the property expenses and interest in today's market, but also gives us a little bit of a buffer when interest rates do increase. Capital growth. So again, we're all here to make money. There's no point investing into a project if it's going to go backwards. So we want to make sure that we've got obviously comparable sales in an area that will substantiate that capital growth. We also want to make sure that we're in a range where, again, we're coming into the market at the lower end, and we've got that potential for that capital growth rise. And the last one that most people overlook, which is probably one of my favorites, is the vacancy rate. So it's all well and good having a property, you've got it secured, but your vacancy rates are too high, which means you might secure a tenant initially, but you're going to have issues throughout the tenancy with people moving in between the property. So the national average in Australia sits at about 3%. We want to make sure that we're well and truly below that. And for most of our clients at AssetBase, the biggest concern is, if I do buy an investment property, how long will it be till I find a tenant? And essentially, how long is it going to be before I have tenants paying my mortgage? Because no one's be left with a mortgage and no rental income coming through.
And look, really what we want to ensure is that you're in a position where you've got 30 people looking at 3 homes, not 3 people looking at 30 homes. So what we want to do is ensure that you, as a landlord and as an owner of an investment property, you get choice with regards to who goes in there. You're not desperate and sort of you throw the worst person in there because you're desperate to get some cash flow. So it's really, really important to do this due diligence up front. So again, making sure we tick those boxes, and you've got to be very, very methodical in your approach, because if you're not methodical and you actually sort of skip over 1 or 2 of these attributes, because it might be something that's a little bit more emotionally, sort of motivated, you'll find that that investment will fall short. So it's really, really important to look at all those attributes. All right, so what I wanted to run through with everyone this evening is obviously what's actually occurred over the last 18 months, because I think we can all agree it's been a really remarkable 18 months. So, if we were chatting with nearly everyone in this sort of, meeting this evening, April of last year, I can guarantee you everyone was very, very concerned with regards to how the economy was going to go, how we were going to go during the first lockdown. And so what's happened is obviously the government have come in with some really, solid stimulus, and it's really turbocharged the property market. So again, it's about buying at the right time and when opportunities present themselves. But basically, this is the environment that we've had over the last 18 months. So we've had record low interest rates. This is the lowest interest rates have been since records were kept. So what that means is that people have the ability to borrow money, and their repayments are very, very low. Okay. People have not been motivated to list their property. The reason being is that we've had lockdown after lockdown. And so what's actually happened is people are a little bit hesitant to put their property in the market because of the instability associated with those lockdowns, okay? Because of the low interest rates, and because of the easier access to credit, which means the banks are lending money, basically buy demand has gone through the roof. Property's been on the news nearly every single night about how it's booming, how there's not enough pieces of real estate online, how, buyers are frustrated. And so what's actually occurred is a fear of missing out. And so what people are actually doing is they're overpaying. So I can't tell you the amount of times where we've helped a client invest in a suburb, and 3 months later, we're scratching our head going, oh my goodness, someone just paid $100,000 more for that parcel of land. Or, someone has paid, $150,000 more for an identical house that we helped the client purchase 3, 4, 5, 6 months ago. So it's that fear of missing out. However, what's actually happening is that we are entering a new sort of cycle with regards to property, because there's macroeconomic factors that are now coming into play. And so that's changing. And it also means that you as an investor need to change the way in which you invest, which is really, really important. So what we've got is the current environment, okay, which is still very, very promising if you're a smart and savvy investor. So what we've identified is that fixed rates are increasing, okay? So where you used to be able to lock in an interest rate, sort of 1 or 2% below the variable rate, that's increased quite considerably. That indicates to us is that the banks believe rates will be increasing, and they're trying to lock in a profit, because obviously, that's the rise in interest rates.
We're starting to see that as well, predominantly in the 3 and 4 year fixed rates. Yep. So it gives you a bit more of an indication that short term, we're probably not going to see too many ripples in the water in terms of interest rates, but the banks are starting to line up that 3 and 4 year fixed interest rate, which obviously coincides with your variable interest rates on the rise.
Absolutely. And also we've got listings increasing. So now we're sitting at 85% national vaccination. So people are a little bit more confident when they're listing their property that they're going to be able to get people through an open house or, do a virtual inspection. So I think at the moment, normally you've got an increase in listings in spring. That's sort of been delayed because of the lockdown. And so listings are increasing. That means as a buyer, you've got a little bit more choice, not a whole lot more choice, but a little bit more choice. So you don't, what that actually means is that, buyer demand continues to remain strong. There is still a fear of missing out, but there is a little bit more stock available, or homes available for sale. What's actually occurred, probably 2-3 weeks ago, or sorry, 2-3 months ago, is the APRA came out and they've increased the servicing cap, which means that they've decreased people's ability to borrow money. But look, I think it was only sort of the vicinity of
works out at about 5% of your maximum borrowing capacity.
Yeah,
so it isn't a huge effect. It was more smoke screens and mirrors, realistically, in terms of the grand scheme of things. But it is starting to show that the government and the banks are concerned about the property prices spiraling. They've started to put measures in to slow that down. And what we'll start to see more so in the upper end, I think, in terms of the property market above that $1 million, $2 million price point, but people where they could borrow $1.5 million for a property, they'll be able to borrow maybe 1.3. So we'll take that sting or that extra cherry on top that everyone expects out of the market.
Well, that's it. And as a person borrowing $2 million, it's quite a considerable amount of borrowings for a principal place of residence. So, it's only, sort of responsible that APRA do that, as long as they don't hurt the ordinary mum and dad, obviously trying to get it, a foot in the property ladder as well. All right. So this is a very, very interesting table, which I want to run through with you guys. And it shows the extent to which, I'm going to sort of do a bit of a comparison between sort of Sydney and Perth. But the extent to which Sydney has grown, for the last, 12 months, it's remarkable. So September of 2020, you're looking at a median house price of $1.15 million. Fast forward, guys, that's now sitting at $1.5 million. So it's a $350,000 increase on the median house price in Sydney. So you'll see nationally as well, it's gone from 816 to 994. I can tell you now the lion's share of that has been sort of Sydney and Melbourne. Okay. Now, a very, very interesting attribute that I want to identify is that Perth remains, just on top of Hobart and obviously Darwin, but the most affordable capital city with a median house price of $598,000, up from $545,000. Now, what's also very, very interesting is that there's a huge disconnect between the growth in both Sydney and Perth. So Perth's only grown sort of marginally, and basically Sydney sort of run ahead, and so
it's bolted out of the gates.
Exactly right.
It's taken a 10-link lead.
Yeah. So what typically tends to happen, guys, is Sydney, when we look at previous sort of property cycles, is always the front runner with regards to growth. So Sydney runs really, really quick. And obviously you'll notice that rental yields in the Sydney market are decreasing pretty substantially. So where you used to be able to generate a 4% return, with the median house price increasing to $1.5 million, your rental yields are now, sort of 2%, if not that.
Yeah, 2.5%.
So very, very little. Whereas Perth generally lags anywhere from sort of 6 to 12 months behind Sydney with regards to capital growth. So what we want to do, obviously, is when we are looking at investing, you do not want to invest when the market has ran from 1.15 million to 1.5, because that is a $350,000 increase. You have missed that market. So what we need to do is identify what market is then going to follow this trend, not to that extent, obviously, to $350,000, but what you want to do is ensure you follow that the most appropriate market that's going to sort of follow that lead. And we believe that's going to be Perth for various reasons, which we're going to go through very shortly.
Yeah, and I always like to liken it to a rubber band effect. So normally what you'll find is that with Sydney's medium house price sitting here, there's normally about a 30% gap between the Perth medium house price. As you can sort of see, that gap has really sort of shot out. And it's the first time that we've ever seen it get this large in history, going right back to sort of 1950s, 1960s. So when you've got house prices increasing at such a rate, there's going to be that pullback effect. And that's going to happen in Perth, obviously, based on these numbers. The big thing is obviously with the affordability side of things as well. We can sort of see that for the average person looking to invest, a lot of the markets around the country now are starting to become quite unaffordable. So when we've got lockdowns that have restricted people coming into Australia, and you've got house prices, the high in Sydney at 1.5, people that are going to start migrating into Australia will be looking for affordability. If people in Sydney can't afford Sydney, then people coming into Sydney will definitely not be able to afford it. And that's where we're looking for that affordability belt.
Absolutely. And look, you even look at sort of Melbourne. I think Brisbane's going to crack $1 million very, very soon on the back of the Olympics.
Yeah.
And even the ACT. What you want to do as an investor is ensure that you jump and decide to invest in a location pre it sort of spiking, like it's happened in Sydney as well. So obviously, why Perth? This is why we're here today to discuss.
So to give you a bit of an overview, and Perth's an interesting market because if you do a little bit of research, you'll find that they've had a bit of a tough time over the last sort of 5-6 years. I was actually working between Sydney and Perth for a fair while. And at the height of the peak that Perth went through in 2014, you had a huge mining boom that was purely fueled by mining. So you had kids leaving school, working on oil rigs and making $120,000, $150,000 a year straight out of high school. What this did is basically turbocharge the economy with somewhat of hyperinflation, where you had breakfast costing $40. You had everyone buying a brand new car. Everyone was buying an investment property. Basically money was worth nothing because people were making that much of it. And then what you had was the government got caught out and wasn't actually investing into any infrastructure projects. So a lot of the money was cycling around, wasn't actually building up Perth. It was literally coming in one hand and out the other. Perth then went through a real slowdown in the mining sector on the back of the global economy. And that pretty much ran for the next 5 to 6 years. So you'll find that during that period of time, a lot of people migrated out of the mines and looked for other employment interstate. So you had a population shift where a lot of people shifted out of Perth itself. You also had a lot of properties that were basically put back onto the rental market because these people were now living there. So you had vacancy rates skyrocket. In a lot of areas, they hit sort of 6-7%. And you had a situation where capital growth started to decrease because there was that many properties available, but also your rents were decreasing. So as an investment, it wasn't worthwhile picking up. And if we go to sort of 2018 right through to 2021, we've always monitored the Perth market and it's waiting for that right time to strike. You can see March 2018, our vacancy rates were sitting up around 6%, probably a little bit higher, around the 7%. But as we taper through, your capital growth was running at a negative. So you're looking at essentially, negative 2% growth that year. We taper into March 2019, and you can see that by then the vacancy rates have plummeted. Okay, so we've got a bit more mining activity happening, got a lot more people flooding back into Perth for employment and stability there. And we can see that we're still running at negative growth. So people are basically buying discounted properties because they're available, but they're actually moving into them. So your vacancy rates are plummeting, okay, because it's not an investment market. We fast forward to 2020, and we're now in a situation where we're down to about 2% vacancy rate, and we're starting to see a little bit of capital growth shine. Very similar to a little blossom coming out of the ground after a bushfire. We're starting to see a bit of a resurgence in the Perth market. Fast forward to March 21, and we can see that we're now sitting at a vacancy rate of just under 1%, which, as I said earlier, anything sub 3% is healthy. At 1%, it's a very, very tight investment market. And that's on the back of, obviously, a lot of owner-occupiers actually moving to the Perth market, lack of investment, and obviously that oversupply being absorbed. And now what we're starting to see is a resurgence in growth. And you can see that, 6% sitting for houses and 5% for apartments. And that trend will now start to continue, because generally what you'll find with a property cycle is it'll run in a 10-year cycle. Perth's had roughly 6 to 7 years of negative growth, and that will now start to swing. And if we run it off the rubber band effect that I was talking about earlier, we're going to start to see it turbocharge.
And the thing is as well is that this level of growth is sustainable. So you've got to remember as well is that when you're investing, you've got to invest in an area where you've got sustainable levels of growth. We don't want to see a property grow by 40% in 1 year and then flatline for the next 20 years. So what we're seeing here is very sustainable levels of growth compared to a market that's sort of boomed per se. So, and that's what we want to ensure, that you as an investor are investing in a market that's got a sustainable rate of growth, but it's also supported by a very low vacancy rate, which is very exciting. All right, so the economy. So what's very, very pleasing at the moment about the Perth economy and the WA economy in its entirety is that it's the only state in Australia currently running a budget surplus. And we're not talking about a small budget surplus, we're talking about a considerable budget surplus. I'm pretty sure the federal surplus, when, probably 3-4 years ago, wasn't as large as this. Now, you're looking at a $5.6 billion surplus. Yes, a lot of that was on the back of some, really good mining royalties for the last sort of 12 months. But what the government is doing this time around is investing every single dollar into infrastructure projects, which is very, very exciting. So you look at, I guess the current unemployment rate in Perth, it's sitting at 3.9%, which is basically one of the lowest in the country. And the reason being is, again, they haven't had to go through the lockdowns like many people have, many of us have had to go through on the East Coast, but again, a really, really low unemployment rate. Again, with very, very minimal sort of interstate migration, because everyone has to go into 2 weeks quarantine, they've still managed to achieve population growth. And I know for a fact that Victoria actually had negative net interstate migration, so more people left Victoria than moved there, and likewise with New South Wales.
Go figure, they were locked down for pretty much
worst
lockdown state in the world. So.
Yeah, exactly right. So, but a lot of this is being reinvested, which is very pleasing, into the local economy. So we've got 4.3% economic growth. and then $223 billion of exports. So it's a huge part of our Australian economy, which is great.
We can also sort of see, you know, probably more of a fun fact or something for the trivia when we get back into the clubs and pubs. But surprisingly enough, Perth, or WA itself, is actually the world's largest producer of iron ore, which is obviously mainly consumed by China at the moment. World's third largest producer of LNG gas, which again is another fuel that a lot of countries are desperate in need of. It's the world's third largest producer of gold, surprisingly, and world's largest producer of lithium, which is obviously all your batteries and renewable energies. Yep,
amazing. So yeah, look, you know, and obviously that's led to this sort of surplus that we currently have at the moment. And I suspect that that's going to be a surplus that will be continued to be reinvested year in, year out. All right, so what are they spending their money on? Well, I'm just going to go through some high level sort of things that I think are pretty impressive. The MetroNet is obviously Perth's equivalent of sort of their local train network. They're spending $1.1 billion, which is almost a fifth of the entire surplus, upgrading the entire network, you know, increasing the breadth of the network, but importantly as well, adding train stations. So a couple of locations that we recommended clients purchase. We've had sort of new train stations sort of turn soil, which is very, very exciting. They're spending $385 million upgrading all the road network, and specifically the Great Eastern Highway bypassing the change. So again, they're investing, which is going to lead to, number one, increased desirability for people to move there, more jobs growth, and more prosperity for the locals as well. And again, not just spending money on I guess, big ticket items, but spending $229 million rebuilding and refurbishing the entire TAFE network right across WA. So again, that's going to ensure that people that do move there, you know, whether it be, you know, sort of local Australians or people from overseas, they'll have, you know, sort of state-of-the-art education facilities for when they enter the workforce as well.
Interesting as well with the MetroNet, and Perth, I guess, is very, very similar to Sydney in the sense that you've basically got a north and south corridor. So there's not a lot of land available along the coastline. So what you've got is the light rail pretty much goes up and north and south, sorry. You've got the highway that runs north and south. So they've pumped a lot of money into be able to get people, you know, an hour outside of Perth, for instance, but can still get on the train, still get on buses and get back in a reasonable amount of time. And similar to Sydney and pretty much our New South Wales coastline, you've got ocean on one side and you've got land that isn't able to be developed inland. So you've got this sort of nice narrow corridor, which restricts obviously the amount of land that can be developed. And once that land's obviously gone and sold, it puts that extra price pressure to get closer to the ocean.
Yep, absolutely. All righty, labour shortage.
So labour shortage, we touched on obviously the unemployment rate in Perth. It's quite tight. On the back of that, we've obviously got a vacancy rate that's sub 1%. Now we've also got a labour shortage, and because of the amount of infrastructure projects that are coming online in Perth, along with the mining boom, they're now 33,000 workers short, or they're, sorry, at the moment, they're sitting at about 20, but they will be about 33,000 workers short coming to 2023 on the mining front. So that shortage of workers is desperately needed to be filled because there's money to be made. And that's where you're starting to see, obviously, the government putting a lot more money into TAFEs to fast track these people getting their qualifications and education to get into the mines. But more importantly, it also opens up overseas or overseas migration. So they've just earmarked 134 occupations that have been added to the migration list. Obviously, we've had our borders shut down for 2 years now, so there's been very little international traffic coming over. But a lot of these skilled workers and migrants are desperately needed, particularly in a lot of these industries. So when they do come in, it's not a matter of can I go to Brisbane or am I going to Sydney to live or Melbourne? It's you're earmarked to go to Perth. That's where their employment is. That's where you're getting led into to obviously fulfill that occupation requirement. And obviously with that, we've got 55,000 additional people to fill the labour shortage. So 33,000 in mining, but an additional 22,000 people that will need to come in and work in obviously occupations like health and administration, in engineering with all the infrastructure projects, etc. So
absolutely. And so you've got to remember as well, you've got a 3.9% unemployment rate there already. So it's a very, very tight labour market. You know, I think nationwide and specifically in Perth, there is a sort of skilled labour shortage. So again, it's sort of identifying where people are going to be migrating to or immigrating to, and also are they going to be paid, you know, top dollar. But importantly as well, are they actually going to be able to afford to live in this sort of location for what they're earning? So we're going to go through that in a tick. So what does it actually mean? So as an ordinary, like let's say you're overseas, you're looking to migrate to Australia. There's a couple of things that you're going to think about. You're going to think, you know, lifestyle. So, you know, you want to ensure that you've got, you know, you're close to, you know, let's say the ocean or good schools or the CBD. You want that lifestyle. That's very, very important. Now, I guess the thing that you're going to have to worry about is, yeah, I do want to be next to the ocean. I do want to be next to the CBD. But, you know, I want to be able to afford to do that. Now, you know, in many other states along the eastern seaboard, you can't actually do that. You know, the median house price in Sydney is sitting at $1.5 million. If, you know, local Sydney-siders are struggling to get into the market, migrants from overseas are going to struggle as well. And likewise, people from Sydney will decide, hey, or Sydney, Melbourne, Brisbane, wherever it may be, ACT, will decide, hey, I can go earn a similar wage in, you know, sort of Perth, and, you know, have that enhanced lifestyle. So what are they also going to do is they're going to chase employment opportunities. If we're running a you know, $5 billion surplus and the government's spending all this money on infrastructure, well, guess what? There's going to be more employment opportunities. So, and people willing to, or in businesses willing to pay a premium for people to come and work for them. So again, thinking not only as an investor, but just as an ordinary Australian, where do I want to be? I want to be somewhere where there's a great lifestyle, affordability, which is a really, really big one, but importantly as well, I want to make sure I've got employment opportunity. So we believe that, you know, moving forward from here on in, this is sort of, Perth itself is poised to tick all those boxes as well.
Yeah, and I think most people would agree that you can normally get one or two of those. It's very hard Absolutely. To be able to tick off all three boxes.
Exactly right.
On all three fronts.
All right, so it's all well and good to buy a piece of real estate in Perth and go, yep, it's going to be great. You know, Perth's going to go up in value. Yep, you know, Josh and Nathan said so. That's not, I guess, always the case. What you need to remember is that, and similar to every property market in Australia, what you need to ensure is that you're investing in quality real estate. Okay, so what we've seen and what the pandemic has sort of earmarked and exposed is that lifestyle is really, really important to people. Flexibility is really, really important to people. So, you know, no one, or, you know, not everyone, but a lot of people don't want to be living anymore in the CBD or, you know, one-bedroom apartment in a high-rise. People do want lifestyle. They want a bit of space. They want their own house. So traditionally, AssetBase has always, you know, traditionally pushed for clients to purchase houses. We do believe it's a superior option. Now,
it obviously comes with land value as well.
Exactly right. So at the moment, good quality real estate is in short supply. It's very easy for you to go online and pick a nice one-bedroom apartment right next to the CBD, but for us, we need to make sure that it actually, we have a belief that it's going to grow in value. I don't think you're going to get the capital growth on, you know, a little apartment or, you know, a two-bedroom townhouse right next to town. So what we want to ensure is that, you know, when you are investing, you know, you're basically buying or purchasing a style of investment that's suitable for the modern renter. And that's changed a lot. You know, people have the ability to work from home. People are happy to commute once a fortnight into a CBD. They're chasing lifestyle. So it's really, really important that when you are looking investing, you invest in quality real estate and something that's going to be desirable for both the renter, but also when you go to sell it, it's desirable for someone who wants to purchase it in the future as well. So that's really, really important.
I think pre-pandemic as well, you know, people spent very little time in their apartments. You know, they would go to work because they had to be in the office 8, 9, 10 hours a day. They would come home, they would go out and go to the beaches, they'd spend their weekends out and about. What we've now sort of seen is because people are spending a lot more time at home, whether it be working from home, whether it be, obviously not going out as much during the pandemic and spending time with family and friends at home, there's that big shift away from, spending time outside or, spending very little time inside your dwelling or your apartment to now I'm spending actually a lot more time. I want space. I don't want to be looking at the same four walls every day. And I want to have that space where I can go outside, work from home, see the sunshine, and I've got a bit more room as opposed to being in an apartment.
Absolutely. So, and that's been our focus when we are looking at Perth, which is traditional housing. So we'll go through that in a tick.
So the next few slides are what we touched on earlier, but the big one for us is making sure that when we do go into investment areas, that we're not jumping into an investment hotspot. So when it is an investment hotspot, what you'll normally find is the herd rushes in, everyone goes into the same area, targets the same sort of assets, and it's all investors. When you get that sort of a situation, there will be, I guess, growth in the short term, but what you'll find is you'll end up in an area where it's predominantly investment activity. That means that you've got pretty much renters on every corner, and it means you haven't got any owner occupiers actually pushing up that market. That's very similar to what happened in Perth 7 or 8 years ago, where a lot of it was investment, which means that you're at the mercy of people actually pulling out. What we've now got is a marketplace where a lot of the market has been absorbed by owner occupiers, so people that have actually moved into their homes. And what we generally find is with owner occupiers, they'll normally spend a little bit more money on their properties because they're living there. And they'll also pay a little bit more to go into certain locations. Absolutely. They'll pay more to be next to the local park, next to the local school, whatever it may be. So we really want to make sure that when we do go into areas, we're focusing on, at least a 70-30 split towards your owner your owner occupier market. And
the thing is as well, guys, is that if you're investing in a location where, every single property in the entire street is an investment property, you go to increase your rent by $5 a week, you give your tenants the opportunity to go, hey, there's 2 houses for lease across the road for $10 a week less, brilliant. So you don't have the ability to dictate to your tenant anymore what you want them to pay. They're dictating to you and you're desperate to keep them in. So it's really, really important that, you ensure that, you've got a higher proportion of owner occupiers who typically tend to have nicer gardens, yada, 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 and looking after their homes. And, a mix of both investors and owner occupiers, but predominantly owner occupiers.
The rental yield. So we generally like to focus on yields anywhere from 4.5% to 6%. That's going to be more and more imperative, particularly with interest rates potentially increasing. So at the moment, with interest rates sitting at about that 3.5% mark, 4.7% return will ensure that your tenants are actually paying the cost of holding the asset. Which is the ideal scenario because no one really wants to have to chip in money each week to hold their investment property. As we start to see interest rates increase, and as we went back to that slide with fixed rates going up in the 3 to 4 year mark, we want to make sure that we've got at least a yield sitting around that 4.5% to 5% mark, so that we've not only got the ability to cover our mortgage repayments today, but we're also putting that buffer in place for the next 2, 3, 4 years time when interest rates do increase slightly. And
ideally as well, you want to cover all your associated costs as well. So exactly. A lot of the times when people say, oh, I'm cash flow positive, they don't realize that, hey, you have to take into account your real estate fees, your council rates, your water rates, your landlord insurance, your building insurance. So, for us, when we're actually doing a analysis on a piece of real estate, you account for all those things. And that's why having a strong rental yield is so important, especially in a changing property market. Yeah. So it's really, absolutely critical.
And we touched on it before, but vacancy rates are probably the most overlooked point or criteria. You could buy a nice house, buy a nice house in a particular area, but little do you know that there's another 50 houses on the market for rent. It doesn't matter how nice your home is, it's going to have to compete in a fairly high, residential investment market. The national average sits at about 3%. So anything sub that, we're in a position to secure tenants fairly quickly. Sub 1%, so 0.9, we'd be comfortable with securing tenants within the first week. We also want to make sure that that's consistent so that if tenants do move out for whatever reason after a year, that we're also able to filter a new tenant in quite quickly. But I think for most of our clients, that's probably one of the biggest concerns that they generally have, because yes, the property could be making you money on paper, but we want to make sure that essentially we don't sit with a property vacant for 3 or 4 weeks where we've got no rental income coming through and we're having to cover the holding costs of $300, $400, $500 a week.
Correct. And the current vacancy rate, in Perth at the moment is sitting at 0.9%. So it's at historic lows. It hasn't been this low for probably 10,
15, 20 odd years.
Correct.
And again, that's across the board. So we've all probably seen a lot of newspaper articles coming out recently, but there's a huge housing shortage across the country, in all states and territories. And what we're starting to see is because this vacancy rate is plummeting to such levels, there's huge demand for new property. There's huge demand in the investment market, which is obviously going to put extra pressure on that rental yield moving forward.
I've seen a couple of articles. Now, they're probably a little bit more specific to sort of New South Wales, but, in certain locations nationwide, there's now a homelessness issue because basically there's probably a bit of an issue on the government. They've not been able to fast track development applications. They've not been able to deliver the suitable types of accommodation. And so there's a homelessness issue that's starting to develop nationwide. Again, like a family are not going to move into a 1-bedroom apartment. So you can build, 1,000 1-bedroom apartments, but it's not suitable for the changing landscape and the changing, rental landscape at the moment. All right, so capital growth, guys. So we touched on this a little bit earlier, but when we look at a 30-year trend, typically what you'll find is that Perth mirrors Sydney very closely. And, the median house price in Perth is generally around 70% of the median house price in Sydney. So they hug each other really, really closely. Perth's always been cheap though. There's no doubt about it. So the thing that I guess is most appealing about where we see ourselves in the current environment is that Perth at the moment is sitting at below 50% of Sydney's median house price. And it's the first time in over 30 years, there's such a disparity between the two.
Yep.
Okay. And we believe that you've got the right economic conditions, the right housing conditions, where we could see a really big spike in capital growth, well in excess of 20%. Now, it's not going to happen sort of in the next 2 months, but it will happen quite rapidly over a sort of a 3-4 year period. So you're achieving a really solid rate of growth, and we're coming off a very low base. So we're coming off a really, really affordable price point. So it's great to make 20% capital growth, but we don't need to borrow $1.5 million to do it. You need to borrow, a third of that essentially.
Yeah. And I think you're also spearheaded by 2 other facets where you've got land supply that's been sort of dormant. You haven't had a lot of investment activity driving up prices. That's now starting to occur. And the other big factor is obviously building costs. So on the East Coast, you're looking at typically about 20%, 25% more expensive than what it is on the West. And that's because we've had so much activity on the East Coast. So that will translate back over to WA. And you'll start to see the costs of materials, the cost of labour start to increase, obviously with that investment growth.
And that'll drive, further capital growth in itself.
Exactly right. So again, guys, we've got a couple of clients that have started to look at the Perth market and actively invest. As we sort of said earlier, focusing on the house and land style option works really, really well for families. And again, we're getting ourselves a land-based asset that's going to obviously achieve a premium on that growth factor. House prices, so complete packages anywhere from that 487 to 497 mark.
And these are, and I'm sorry to jump in, these are 4-bedroom, double, brick homes with double lock-up garages. So they're not, 3-bedroom homes with a single lock-up garage, which we're starting to see quite a lot of. Yeah, a lot of in like Melbourne and even in Brisbane and things like that.
Yeah, we want to make sure that we're building for the long term. So you don't want to be building cheap and nasty. You don't want to be sacrificing space. You really want to be putting in that little bit extra to ensure that you're getting the best tenants. You're going to get the best opportunity for growth. A lot of these locations, as I said earlier, Perth runs very much north to south. So these areas are all sort of 35 minutes to 45 minutes from Perth CBD, with access to public transport and that train line or that metro link running straight back into Perth. Now, you've also got a lot of satellite cities, which are, you know, for all our Sydney siders, almost comparable to the size of, you know, your Maitland LGAs in Cessnock. So your whole Hunter Valley precincts,
Central Coast,
Wollongong. So with that in mind, 35 minutes from Perth CBD, a lot of people won't necessarily go back into Perth. They'll travel back into these satellite cities as well. Population movement's the encouraging thing, or the population growth, 2.9% per annum predicted to 2036. And that's without borders opened. So that's the big driver, or one of the big drivers in this capital growth push. As people start to flood back into Perth, vacancy rates will tighten even further. Property prices will start to grow and increase. Vacancy rates, as we said, we want to make sure that we're achieving at least a 4.5% return to ensure that we've got our rent and our holding costs being covered. But we also want to make sure we're insulated for the next 3 or 4 years. It's pretty hard at the moment with the growth that Sydney and Melbourne's seen to achieve a yield, you know, higher than that 4% mark. But in Sydney, it's sort of 2.5%.
Oh, it's near impossible in Sydney.
So as an investor, it makes it really, really challenging because most people will be in a position where, again, Sydney's going to come into a very, very flat sort of a period moving forward. And what we're going to have is people buying in at that market, sitting on a flat growing asset, but also having huge holding costs.
Well, that's it. And you're going to be having to find hundreds of dollars a week just to hold those assets.
Exactly.
So, and that's not a strategy that we're comfortable recommending.
Vacancy rates, again, 0.9%. So we're not going to have too many issues in securing tenants, and predicted growth over the next 5 years is sitting at 5% per annum. So again, a nice healthy return coming off a low base. And then that's that rubber band effect that we've been speaking about. There is that nice little pullback that we're going to get on the back of the Sydney market.
Other locations, guys, so a high price point. This would be a little bit more of a coastal location. We're looking at 515 and 548 packages. We are a little bit further away from Perth. However, we're, you know, sort of hugging the coast. So a lot of these homes are, you know, sort of 2-3 minutes from the beachfront. We've got strong levels of population growth, really strong rental yields, and again, a vacancy rate that's really, really strong. Again, really strong capital growth projections. So, you know, these are the areas that we've sort of earmarked and we're focusing on quite heavily, you know, where we do believe there's, you know, the attributes that will give our investors sort of a leg up as well. And what I'm very pleased about is, you know, and I think we'd all agree here, I'd be surprised if everyone doesn't, is it's very, very affordable.
Yep.
Compared to, you know, sort of your major, any other capital city. And even sort of regional New South Wales and regional, you know, Victoria, or even regional sort of Queensland as well. These are very comparable sort of prices. As well as that, obviously, like I said, similar price points. You've got 515 and 548, 60 minutes to Perth. Again, more coastal location, 2.9% population growth, and again, hitting all the right attributes there. Like you know, with regards to locations, if it is something that you want to explore, we're more than happy to catch up with you. You know, just reach out to us, which we'll go through in a tick. But obviously, we do. You know, we have had clients investing there with a lot of success, and obviously, it's something we want to share with you as well. So.
I think one of the big ones as well is the coastal locations. So even looking at in today's market, we've seen a huge boom in New South Wales coastline.
Yep.
Sunshine Coast has boomed on the back of everyone wanting to be close to the beaches. So a lot of the areas that have moved have all been fundamentally grounded by coastal or close proximity to coastal locations.
Mm-hmm.
And what you start to find is that essentially with coastal locations, you can't go left, right, north and south. You've got coastline on one side, and it becomes a situation of you're either going to pay a premium to be a 500-metre walk to the beach, or you can pay less, but you've got to get in your car to drive to the beach. So a lot of these locations at the moment are getting quickly developed over in WA, but you are still within sort of 800 metres, 900 metres of the coastline, which if you fast forward 10, 20 odd years, will be
a very desirable
product. Yep.
Yeah, absolutely. Absolutely. And I mean, and that's the thing, it's all about making sure that you've got the appropriate, and again, we spoke about it earlier, but suitable to the growing needs and the changing needs of sort of the population as well. So, you know, again, you know, you're just not going to have families moving into 2-bedroom apartments.
Yeah, not every property will boom. It's got to be the right one.
Absolutely. All right. So look, today is not really just to I guess, you know, sort of sell you guys anything. What we wanted to do this evening is deliver you guys a bit of value with regards to where we believe the market is sort of moving and where we believe the next sort of growth opportunity presents itself. So we have nothing to sort of sell you guys today or run through or sign up today. Basically, what I'd like to do is basically run through some questions that you guys might have, if you could put it in the chat box. And then I'd encourage you to email us if it is something you're looking at pursuing, or if it is something you're interested in looking at further. If you could email info@assetbase.com.au, I'll also put it in the chat box. We can actually arrange a time to catch up and run through it all. Obviously, we're coming into Christmas, so it's also going to be very, very difficult to catch up with everyone in the next week. But we'd love the opportunity to have a chat with you prior to breaking up for the Christmas break. And then obviously we can arrange a time to potentially catch up in the new year and explore, you know, an opportunity that might be suitable for you guys. But at the moment, let's have a chat and run through any questions that you might have in the chat box. And I'll just basically put in our details as well. Nate, I'll let you answer that.
What sort of vacancy rates are you seeing in Brisbane and Adelaide? So yeah, great question. Vacancy rates across the board are tightening up. So what we've sort of seen is it doesn't really matter at the moment in a lot of locations. There's a huge shortage of housing supply. If we're looking at Brisbane and Adelaide, Brisbane's always typically been known to have a bit of a saturation of apartment stock. So you'll find that the vacancy rates in inner city apartments have always sort of sat a little bit higher than what they should. That market has been absorbed. So interestingly enough, you've got a situation in Brisbane CBD, for instance, where typically you'll need, about 8,000 apartments coming to market in a typical year. At the moment, or this year to date, they've had about 800 come to market. So you can sort of see, even in the Brisbane apartment market, there's not that equilibrium that's needed for that consistent population, or sorry, that consistent property coming to market. Adelaide itself, you'd be looking at about the 3% mark.
Probably a tad less. I think the concern, I guess, Adelaide's obviously, and I lived there for 2 years, it's a great market. However, it's always been heavily dependent, obviously, on university students moving in there, which hasn't occurred. Yeah. And as well as that, it doesn't have, I guess, the budget surplus or the population growth, which we're anticipating to occur sort of Australia, in Australia. On the back of, sort of going back, Nathan, Brisbane itself, obviously, you've had a ridiculous run where you've got the Olympics that were announced. And then as well as that, you've got people chasing the sunshine. I know, at least from my personal group of friends and colleagues, a dozen people that have moved up to Brisbane. But again, whether or not the economies themselves in both Brisbane and Adelaide can sustain sort of that vacancy rate, I'm not sure. They're just not running as much as a bigger surplus, and they're not spending as much on infrastructure. Any other questions, guys?
Well, we can't be that good at explaining things.
Perfect. So with regards to the train line, the expansion of the train line and additional train stations are occurring both north and south of Perth itself. Okay, so there's some additional train lines all the way up to Turock.
Yeah, Turock, Yanchep, all the areas being developed.
And actually going past Mandurah as well. So again, you don't also want to be at the absolute end of the train line, because obviously, the all stops train into Perth is going to be quite a decent commute.
Long way home.
Exactly right. However, yes, the train lines are expanding both north and south.
And I think the other one is it's not just the train lines that are expanding. So there's new train stations actually being developed
On the lines.
the lines as well. So, you know, more train lines, more parking, more accessibility.
Yep, perfect. All right. So with regards to the projects, look, if you do want to discuss the locations, feel free to reach out to us to let us know. However, what we typically like to focus on is basically 200 plus square metre 4-bedroom homes. You know, very good quality. We're not talking about lightweight construction, brick veneer homes with a higher specification. Okay, so that's very, very important. So those homes will be sitting on blocks of land from, you know, I think the smallest block of land is around 375-ish, which is your lowest price point, up to about 600 square metres. So it really just depends on sort of price point and what you're comfortable with. With the larger blocks of land, you will not get the rental yield. So you'll be paying an extra $50,000, $60,000, but you won't be getting the $50, $60 a week. So again, it really just depends. But those homes are basically homes that we look to build, so house and land packages. We specialize in that field, and we're we're currently building over 200 houses at the moment for clients nationwide. And obviously accustomed to making sure that that process goes nice and smoothly as well.
Yeah, and we've got a bit of a luxury because with all the developments happening in Perth, a lot of the projects are not only close to the oceanfront, but also within, you know, a 5-minute commutable distance to your shopping centres, to your schools, to train lines and networks. So because of all the infrastructure spend that's going into Perth, you're not sort of finding yourself in a location that's developing, but also 30 minutes away from any sort of infrastructure. You're in areas that are being really, really quickly developed with infrastructure ready to go.
Yeah, you don't want to be like areas that are very greenfield, where we're kind of a little bit worried about. You want to be looking at locations that have got some established infrastructure around it. So again, like you don't want to be the first house and you've got to travel 15 minutes to get to Woolworths to get milk. So, you know, for us, it's about making sure that you as an investor are sort of taking advantage of established infrastructure, but you're in a desirable location as well. Any other questions at all? Alrighty. Well, guys, we might wrap up. Like I mentioned, if this is something of interest to you, we really, really appreciate, you know, just reach out to us, have a chat. Just email us at info@AssetBase. Again, we're not here to sort of push any specific product, but we really wanted to give you guys our honest opinion and research on where we think the next frontier will be for growth. You know, we've had clients invest along the East Coast for the last 24 months with a lot of success. Yes. Yeah, that's some leftover mustache from November. But yeah, we've obviously had a lot of clients invest over the last 24 months on the East Coast with success. However, our job is to obviously ensure that our clients are ahead of that trend, and hence why we put on this information this evening.
Cool, guys. Well, Merry Christmas. Don't drink too much and eat too much. I know you will, but keep it in check. If we don't see you before the new year, Happy New Year. And we're looking forward to a bigger and better 2022.
Absolutely. Thank you, guys. Have a great evening.
Bye.
Take care.